Picture this. You've just moved back to India, it's tax season, and you're staring at your ITR filing screen. You skip right past that Schedule FA tab, hit Submit, and think you're done. But leaving your foreign assets off that form, well, that's a mistake that could literally cost you everything. Welcome to The Explainer.
So, you return to India. You've got a 401k, a US bank account, and some RSUs sitting overseas. And absolutely none of them are in your ITR.
Here's the terrifying part. The IT department already knows about all three. Yeah, turns out they're way better at global networking than we give them credit for.
Okay, let's dive right into this. Schedule FA is the mandatory foreign asset declaration section in your tax return. The exact second your tax status changes to resident and ordinarily resident, or ROR, reporting your global wealth becomes an absolute, unavoidable legal requirement.
And what happens if you skip it? You're looking at a brutal flat penalty of 10 Lakh rupees. But wait, it's not just a one-time fee. That 10 Lakh is applied to every single missed asset per year under the Black Money Act. I mean, the severity of this mistake just cannot be overstated.
So how exactly do they already know about your offshore money?
And this brilliantly illustrates the inescapable trap you fall into. It's a completely automated data flow. First, your US bank or brokerage collects your account data. Then, thanks to the FATCA Global Banking Treaty, they're legally forced to hand it over to the US IRS. The IRS then automatically shares this info with the Indian IT department. Finally, all that data lands right in your annual information statement, instantly triggering an automated mismatch if your tax return is blank.
Let me state this with absolute certainty, just to shatter the biggest myth out there. The IRS sends your account data to the Indian IT department automatically every single year. Seriously, your foreign assets are not invisible to Indian tax authorities. Not anymore.
Now, let's look at the big three assets that trip up almost every returning NRI.
Number 1, your 401k and IRA retirement accounts. Number 2, your US checking and savings accounts. And number 3, your RSUs and ESOPs. Yes, even if they're totally unvested or unsold, you have to report them. Saying, "I didn't know," is simply not a defense here.
Which brings us to the real nightmare, the black money trap.
Now, what's really interesting about this slide is how these penalties dynamically stack under the Black Money Act. You aren't just paying a tiny slap on the wrist fine. If an undisclosed foreign asset is found, you get hit with a flat 30% tax on its fair market value, stacked instantly with a massive 90% penalty. That's a total exposure of 120% of the asset's value. You're essentially wiping out the entire asset and potentially facing up to 7 years of prosecution. Crazy, right?
A lot of folks fall into this trap because of a super dangerous misconception about their tax status. See, when you first move back, you might be an RNOR, resident but not ordinarily resident, which legally exempts you from Schedule FA. But the very moment you transition to a full resident, or ROR, every single foreign asset has to be disclosed. Oh, and keep in mind, Schedule FA looks at the foreign calendar year, January to December, not the Indian financial year.
But don't panic just yet. Let's talk about the FASTDS 2026 Lifeline.
Newly introduced in Budget 2026, FASTDS stands for the Foreign Assets of Small Taxpayers Disclosure Scheme. It's basically a strictly limited, one-time, 6-month statutory amnesty window. It lets you voluntarily disclose your unreported foreign assets without facing those catastrophic consequences we just talked about.
So, the crucial point is exactly what this scheme offers returning tech workers and executives. It gives you full immunity from prosecution. It gives you full immunity from those devastating 120% black money penalties, and it's designed specifically for genuine small taxpayers who just made an honest mistake with their RSUs or legacy accounts.
And what's the damage to fix this? Well, if your total assets are up to 5 crore rupees and you've already paid the required taxes, like on your taxed RSUs, cleaning up this entire mess costs a flat fee of just 1 lakh rupees under the new scheme. Honestly, that is an absolute bargain for your peace of mind.
Because look, the government's intent here isn't to ruthlessly punish genuine mistakes. The whole point of these Budget 2026 reforms is to bring small taxpayers into the legal fold transparently. They want to make your global compliance simpler and keep your hard-earned wealth totally secure.
Let's move to your compliance action plan and see how this builds together.
Missed declaring your assets in your FY 2024-25 return? You need to file a revised ITR by December 31, 2025.
Taking this voluntary disclosure route and filing a revised return before the deadline is the absolute best way to lower your penalty risk before a scary notice ever hits your inbox.
You simply cannot hide your assets from the global tax network anymore, but you can fix your compliance right now. DM me FA for a free Schedule FA asset checklist, and let's get your taxes sorted. Because think about it, if they already know about your 401k, what else is hiding in your global financial footprint?